Hello, everyone. Welcome. So I feel like I'm repeating myself, but this was a very turbulent year for the industry. Europe has continued to become less friendly for brokers, joined by Australia, which is definitely not a safe haven anymore. And in what seems to be a causality and not correlation, volumes are dropping. All this, of course, pushes towards bigger consolidation in the industry. On the other hand, we see growth in other regions like Southeast Asia and the GCC area with brokers obtaining local licenses. So with us here, we have the truly juggernauts of the industry that will shed light on all this. So with great honor and pleasure, I present the CEO's panel. Let's start from Andrew, and we'll just make a quick round. Introduce yourselves, and we'll dive into the questions. Please.
My name is Andrew Ralich. I'm the CEO and co-founder of 10 Financial Systems. 10 is a bridging aggregation risk management provider. Been servicing the retail market now for over 10 years. Currently partnering with over 300 firms in the industry. Very excited to be here, and thank you as always to Finance Magnates for putting on the show.
My name is Mohammed Rasool. I am a director for Trade Tech Group. Trade Tech Group is a combination of different financial entities from CFH Clearing, which is a prime-of-prime broker, to Trade Tech Alpha, which is a non-bank market maker, to our technology division, which offers a variety of different services and systems and solutions for retail brokers, as well as Markets.com, which is a B2C broker. So we cover pretty much everything.
Hi. My name is Harpal Sandhu. I'm a CEO of Integral. So Integral is a technology platform company that services a number of different segments, including the retail segment, but we also service banks and asset managers. Part of the reason that I'm here today is to actually talk about a new initiative that we've rolled out this week together with Jefferies Securities called TrueFX, which is a low-cost credit intermediation and technology solution partnered with a number of leading market makers that we think will significantly change the cost structure associated with trading, particularly in the retail side of the market.
My name's Andrew Edwards. I'm CEO of Saxo Capital Markets UK. Saxo has been around for about 25 years. It's a multi-asset global brokerage. It has a B2B, B2C operations, particularly focusing on retail, institutional customers, and then we have a wholesale offering.
Good morning, Richard Elston, Group Head of Institutional for CMC Markets. I feel like, Andrew, I could almost repeat exactly what you said there. So we're very much a global brokerage, founded in 1989, listed on the London Stock Exchange, multi-technology, multi-asset class, offices in 14 countries around the world. It is facing both B2B and an ever-burgeoning B2C business as well.
Thank you all. You noticed we have two Andrews, so it's going to be a challenge. So let's start with a kind of a warm-up question, and let's make it short. What is the single most quintessential trend that you see now in the industry? Try to focus on the general notion of things and not only on your day-to-day. If you would single out one trend that is the most interesting one and most important one, what would it be?
Sure. So you mentioned that it's been a very turbulent year here, and coming into the panel, somebody mentioned to me there's a very interesting vibe here at the conference this year, and I think turbulent might be the wrong word for it. Regulation as a trend has been a massive topic for this industry for as many years as we've been coming here, and I actually think the point that we've reached today and looking forward in the industry is very interesting, because we're not fearing what MiFID or ESMA or an ASIC leverage cut or these things are going to do to the industry. We're here, we're operating now in a reality and a foundation on this business where a lot of these initiatives have gone through. There's still volume going on, we still have our businesses running, and it's actually, I think, a very exciting time, because for the first time in as long as I can remember, the focus of a lot of the leaders of these businesses and brokerages and providers here today are able to proactively think about their business, not reactively think about what is this regulation going to do, but given the state that we're in today, which is static and regulated and has longevity to it, we can now look at our businesses and say, how are we investing in them for the long haul of this new norm?
I would echo a bit of what Andrew said, but I think I would probably summarize it in one word, which is identity. I think that for such a long period of time, there's been very much, the industry's been unsure about what's going to happen. So whether that's regulatory matters, whether it's cryptos and the impact of crypto versus fiat, a lot of these things have been kind of up in the air. Now a lot of that is settled, and I think most brokers now are looking at what is their identity? Who do they want to be? I said a bit about that last year, and I think now more than ever, once we have seen now kind of how certain things are shaking out, what I hear over and over and over again from most of the B2B prospects that I interact with is questions to us that has to do with who they are and what they really want to specialize in, where they think they can add value to acquire customers, and so they're searching for what's their identity going to be. And I think that's, if I kind of group it all together, it's that one word, identity. Like, who are we?
So I think, first of all, when we talk about the industry, there are various geographical segments, obviously, that are operating in the retail space or margin trading. In each one of those, they've gone through, and I've said this before at other conferences, they've gone through their sort of arc of maturity that is driven by a lot of things, but one of them being regulation. I think in Europe, given the last couple of years where the regulations were tightened up quite a lot, it went through exactly the same emotional shift that other markets that were a few years ahead of Europe had gone through. And so we have the advantage now of looking at sort of what those markets did once it was past the, and I wouldn't say, I think it's just the establishment of a baseline of regulation is all that happened in Europe. So once that establishment is done, what happens to those markets? And so, I mean, for example, you can look at Japan, and in that particular example, the regulations went into place around somewhere between 7 and 10 years ago, and there was a significant drop-off in volume, greater than 50 to 70% in the first year or two after it took place. And in the next couple of years, what I think you saw is initially a consolidation of the actual brokers, but B, which I think was really the fundamental enhancement that took place to that market, was a significant restructuring of their operations for scale. So what they couldn't make in margin on a trade, they made up for in volume, as long as the margins were obviously incrementally positive. So if you, and you look at the results today, I mean, Japanese brokers will do, easily a factor of 4 or a factor of 5 larger volumes than brokers in other parts of the world because they really have engineered themselves for scale. And one of those aspects of scale is cost reduction. Significant cost reduction, significant automation of their environments, and they've really done a fantastic job at it. So I think if there's a single word that's going to come in for this market, it's going to be re-engineering people's operations for scale. And the biggest piece of that is going to be refactoring it along the cost lines.
Yeah, I think echoing some of the comments made there, I think the two big trends we've seen and we'll continue to see going into next year will be efficiency. I think the industry is now moving from a phase of growth into optimization, particularly because of the regulatory pressures we've been put under. And then the second thing will be reviewing business models. We know that a lot of the business models that operated in the past are being challenged. We know that some companies are looking to diversify into other asset classes, and we're seeing a lot of that with our wholesale offering. But I think it's also, I think you made the point, it's almost an opportunity now. I think the road ahead is more clear. We know which way the regulators are going, and it's not just across Europe and the mature markets. We're seeing that across the immature markets. So people are reviewing their business models. They clearly need to get efficiency, and they clearly need to decide whether they want to be single asset focused and go deep into a market, go deep into individual geographies, or whether they want to start branching out into multi-asset and more geographies. So I think you'll see a lot of even the established firms taking quite big strategic directional change.
I think much has been said. I would agree with regulation probably has been the greatest factor. I mean, not just ESMA, which of course comes to everybody's mind, and what we see ahead of us where ASIC is concerned, but other regulation. I mean, we've had GDPR, we've had MiFID. It's kept a lot of lawyers and compliance people pretty busy and probably quite wealthy as well. But I mean, it's the change in regulation has exacerbated behavioural change, both where it comes to retail clients and also behaviour of your B2B clients as well. So whether that's maybe created a greater level of internalization for certain types of flow. But the one thing I think is apparent is that, yeah, we've got some change coming up with ASIC, which is fairly imminent. We're in the consultation period, but we do know where we stand post-ESMA now. And while that Japan factor that Harper was talking about, so there's a massive shrinkage and then a recovery that comes from it. Yeah, we've seen that. And I think that can give some solace to certainly people, to brokers here in Europe, on the note of the kind of clients that we're seeing at the moment. There's definitely less churn. People are holding positions for longer. There is probably arguably a greater amount of money on account, but certainly more coverage in terms of margin covering positions, at least anyway. So it's had a long-reaching change, but we're in a good place. Maybe it's the identity word that Mohammed was saying. We know where we're supposed to be.
Thank you. So all of you mentioned how brokers are coping with the regulations, and you mentioned restructuring and changing the business models. But also some brokers turn to going offshore or going to less regulated locations. So my question is, Andrew, let's start with you. How is it sustainable? Is it sustainable for the long run? And what are the main obstacles that those brokers are facing?
Yes, so we know the direction of travel of regulators in Europe. We can see that now playing out in Asia. And I think, I spoke to someone earlier this morning, even some of these lowly regulated markets are going through consultations now and following suit. So I think companies need to make a decision. If they want to play in a regulated market, ultimately they're going to have to play by the rules of that regulator. And there are short-term opportunities to possibly move offshore and move some of those customers into that offshore environment. But the regulator themselves are there to protect those retail customers in that market, and they will continue to pressure the industry to play by their rules. So I think that is quite a short-termist view. That said, there are a number of markets out there, huge growth markets you mentioned in Asia, which haven't clearly defined the regulation around some of these products. And for that reason, I understand why going offshore to various locations to penetrate those markets is a wise decision. But I do think when it comes to the mature, established markets, it is going to be an ongoing pressure we're going to get from the regulators, and we're going to have to play by their rules. We're going to have to operate within that market. We're going to get constrained by capital requirements. And I think what we'll see is companies that are really committed to investing for long-term growth in that market will survive, and brokers that are not prepared to establish themselves and try and target that market from abroad will have a short lifetime.
Richard, what do you think? Are you as skeptic as Andrew about this?
Yeah, I am. I'm not a big fan of the offshore solution. I think it's a transient quick fix. Yes, it has worked. I'm sure for many people, longevity is the question that I would have around that, and I would like to see commitment from larger. And I'm sure that it's the case that larger brokerages are committed to their tier one geographical regulation or regulatory geographies. Longer term, will it exacerbate consolidation? Maybe. I think it is transient. I think it won't last forever. You can't get inside the mindset of every client, and of course there are people that are very happy to onboard to a slightly lesser known entity or geography, but I don't see us ever doing that.
So it's not a solution for the long run?
No, nor for us.
Okay, moving on, Arpal, Citibank recently rolled back its offering for FX platforms. And I wanted to ask you how will it affect basically the credit prices, and what are the solutions that the industry has now to mitigate this?
Well, so, I mean, I'll answer the question in terms of the cost of the infrastructure. I don't think it's necessarily, directly related to the move of a particular bank. I think it's just over time, the interbank infrastructure associated with credit, clearing and settling FX transactions has begun to represent a larger and larger part of the costs associated with settlement. In the past few years, especially as margins have come down and those costs have remained relatively fixed, the percentage has become relatively onerous. I mean, hence the creation of a lot of very interesting sort of technologies to attempt various types of netting and compression and so on. That cost structure trickled down through the entire industry. And in the current world, I'd be surprised for people to have infrastructure costs, at least on their hedging side, that are below, $3 a million. And if they include technology costs and other things, it's probably in the neighborhood of $5 a million. And it's just prohibitive to some extent for people to operate in that world. I think it limits volume. I think it limits people's options in terms of what they can do in terms of B-booking or STP trading and so on. So we looked at the situation from an engineering perspective and from a relationship perspective of other leading firms that we knew of in the industry, and looked at ways of re-engineering that entire underlying infrastructure and removing various costly steps in the process. And by partnering together with Jefferies and a number of leading market makers, we've been able to offer a solution now to really the buy side of FX, brokers like they're sitting up here on the panel, where we can literally cut their cost of execution in FX markets from anywhere between 50 and 80%. And I think it changes the calculus fundamentally about how they look at hedging, how they look at risk transference. And if their cost comes down that significantly, I think they just look at things differently. And the analogy we like to use is that, there was a time when people paid upwards of $1 for a minute of a phone call on a cell phone, on a mobile. And in that circumstance, it was used quite sparingly. Adults, business professionals, et cetera, would use a device like that. Over time, once mobile companies moved to the point through scale of essentially reducing the cost of a minute of calling to essentially zero, the use case of the communications device just went through the roof. And today we have mobile phones on our wrists and mobile phones with kids, and people have multiple phones, and it's just a totally different use case. And that all came from a radical cost reduction. And I think what we are looking at now is a phase that we're going to enter into where the risk transference and trading infrastructure that is out there is going through a radical cost reduction. And I think when that happens, it will open up a lot of different opportunities for how people interact with each other and trade. Our belief, actually, and again, this comes back to the Japanese model, is that volumes will significantly increase when the cost of transactions and the cost of managing risk and the cost of hedging, the cost of transferring or outsourcing that risk management to other market participants comes down precipitously. And I'll just tell you, in our example, the PB cost itself will come down between 50 and 60%. Integral is offering all of our technology solutions to the buy side for free. So technology costs go to zero, in essence, and credit clearing and settling costs drop by more than half. So if anybody here is actually paying for an aggregator today and paying for technology, especially on a per million basis, it will just be considered obsolete within 6 months.
Andrew Ratledge probably wants to.
So there's a very popular
That's
idiom.
the moment I've been waiting for.
Yes, there's a very popular idiom today in the world of the freemium model, where if you're not paying for the product, then you are the product. And I actually, the first 80% of what Harpal said, I agree with 100%. Transaction costs need to come down in order to facilitate restricting margins, reducing margins in this space. And there's always this tendency in a decade in this industry of I started going to the P&L conference in Chicago when the CME would explain that, I don't know why all of you are here building technology. All of FX is going to be on exchange in one central venue. It's going to be called the CME, and there's going to be no need for any of these other solutions. And there's always a tendency to look at the FX market and how fragmented it is, regionally, liquidity-wise, taker and maker type participants, and say, oh, the easy solution is we know how to do it, and we're going to build the pool that solves everybody's problems. I think the cost compression that's going to come, and we at 1.0 have always embraced the idea that the most interesting challenges of this market and the thing that will never go away is the fragmentation and the bilateral relationship-driven nature of taker and maker or liquidity provider and buy side. So how we look at this problem is slightly different. Instead of saying we have the solution and building tools and bringing a liquidity and saying, you know, this is what you need to use to bring your costs down, we're doing something that we've taken from our experience in the institutional world and helping facilitate better conversations between clients and LPs through data-driven exercises to allow brokers to utilize the information that's coming out of their system. Maybe a pre-curated pool is the right thing for them, but also maybe a bilateral relationship with a non-bank liquidity provider who can facilitate a specific regional behavior or type of flow. Maybe it's about having a big blend of banks and spreading liquidity around, and there are great tools and prior art to doing this type of analysis. It's markouts, decay curves, and for a long time in retail, we were hindered by the fact that we're actually in some ways much more complex than the institutional world. We do hundreds of yards of volume a day, but we do it in an average ticket size that institutional platforms tend to fall over when we spray a full retail broker's flow at it. So now that we've introduced and had this time to step away from regulations and reactive stuff and focus on the future of this space, we're bringing tools to brokers that say, hey, use your data, have a conversation with your LPs. If they say your flow is sharp, you don't have to just say, I think that means it's bad and I have to find another LP. Bring out data that says, well, how can we have a better conversation or relationship? And don't necessarily rely on your technology provider or your LP to tell you where you need to go with your business or how you need to redirect your flow. The unique thing about your business is your client data and what you do with it, and so we're helping brokers use that to find the right ways to address the same problem. Bring down your costs of clearing and liquidity in order to address the compressing volumes and margins that we see in the space today.
Can I
just before you do, I'm just curious if any of the brokers want to kind of dive into this debate.
I think we're talking about the entirely wrong thing. We're talking about variable costs that are associated with business that you already have or growth that you have. I think that if you're operating a brokerage firm right now, your probably biggest concern is your fixed costs. You talked about fixed costs for the banks and why some of the banks are coming out of the market because there's just not enough money in it for them. I think that that's going to happen. We're also just talking about FX. This market is so much more than just FX now. If you're going to make it or break it on just FX, I think you're at the wrong conference. I think that we should be talking about how we can decrease brokers' fixed costs, how we can decrease their infrastructure costs, the same dilemma that the brokers had. Variable costs on order flows, that's a good problem to have. If you're having a problem in talking to Andrew or Harpal about the bill that you're not charging them and that you are, then that means that you're doing okay. And I'm also, been in this industry for long enough to know that there's nothing for free, no disrespect. But if you're not paying your technology provider, then you're paying it in the cost of the transaction itself. It's going to be in the spread. I mean, that's just not how the market works. It never has and it never will.
Yeah. Can I just clarify something?
Very shortly because we have
I
to...
completely agree with everything Andrew said about what you need. And that is exactly what you will get now at 80% less in cost. So we're not proposing at all that it is a curated liquidity pool. It is entirely an OTC market. We invented this stuff 20 years ago. You can bring your own liquidity providers to the network. You can trade bilaterally disclosed. You can trade anonymously. You can trade against a central limit order book. You can trade against midpoint matching. What we are saying is all of those microstructures are available to you. You can trade with whomever you want. You can have all of the data science to see your markouts and the value of your flow and the service level that the liquidity provider is providing to you. You can just do that at a radically reduced cost from where you are today. And we do believe that if the cost is reduced by that much because of the entire re-engineering of the underpinnings in terms of how people are trading with each other, when your costs go down, you have much greater margins. When you have much greater margins, you can decide what to do with that. You can either be more profitable, you can fund more marketing and sales, or you can pass that savings on to your customers. The most important thing, though, is that brokers are going to do this. And the reality is if the competitor is doing it and they're passing those savings on to the customer and you are not, you're just not keeping up with how technology can completely change a cost structure. And that's exactly what is happening now in this industry.
Okay. So, Mohammed, you touched on this slightly on the issue of multi-asset offering. So it's been with us for quite a while, but some brokers are kind of reluctant to dive into that and want to stick to one or maybe a few assets only. So I wanted to ask if something changed this year and why, from your perspective.
From my perspective, I've been talking about multi-asset for the last few years. I think that it's something that everyone needs to be focused on. I don't think that an FX shop is viable long-term. One shop, one stop for FX, I just don't think that anymore. And again, to pivot back to the other part, a lot of these things that we're talking about, whether it's central limit order book, bilateral this, whatever, this is finance magnets. This is retail brokerage firms that have been in this state of flux for years and now have finally got some solid ground to stand on. And what you care about is when your trade needs to get done, that it gets done. All of that other complicated stuff, that's more of an institutional dilemma. That's the bank market makers and the big non-banks and how they're going to lay off their risk into the market. Retail brokers care about what's the price that my customer is trading on, and is that mom or pop sitting at home trading FX or Dow or DAX or CAC or shares of Vodafone or BHP Bilpin, are they happy with their execution, right? And it doesn't have to be complicated. That's always been our value add, and a lot of us here is that we will take care of that part. You just focus on acquiring the customer, right? And I think that is, when I talk about identity, that's what I'm talking about, is like you don't have to get involved in every little bit of the intricacies of how operationally trading happens. And you shouldn't, unless you're big and you have scale and you're maybe perhaps sitting up in this panel, then it's probably not something that you should want to worry about. So simplify. Most answers in life that are true are simple. Right? So simplify your existence, focus on what you can control and what adds value, and figure out who you are. Multi-asset, I think, is the only option forward. And I think it's FX, I think it's, in the UK, it's spread bets, it's CFDs, it's cash shares, it's exchange-traded futures, it's everything. The brokers that are going to be here 5-10 years from now are going to be multi-asset. And not just multi-asset when it comes to derivatives. It's going to be all different types of financial products. That's my personal opinion. And I think that's the direction that the industry is going because of the consolidation, because of the regulation. And I just don't see, I said 2 years ago on this panel, the markets used to be a lot more forgiving. And that's the same message now. You have to focus, you have to figure out who you're going to be, and you're going to have to contemplate a multi-asset offering and give that to your customer. Otherwise, you're just not going to be able to survive. I believe that now.
Andrew Edwards, what do you think?
So I agree with everything.
Rolling back to the multi-asset topic.
Yeah, I agree with everything that Mo says. I think there's two important factors when a say single FX broker looks to move into multi-asset, and the first one is complexity. It is extremely complex, comes with huge back office costs when you move into multi-asset, and I think one of the big decisions brokers will have to make is, do they build or do they lease it off someone like a Saxo? So, and we've seen a lot of interest of FX brokers looking into multi-asset. I think in most cases they underestimate the complexities with that. So you really have to be committed. That's the first thing. The second thing is the business model is completely different. As you move into single stock CFDs or move into cash products, your payback period moves from, we've heard, some companies are getting payback periods of 8 months to 15 months. Your payback period moves into a number of years. Your acquisition costs can often be much lower, so the whole model does change. And again, it does require investment. The big advantage of that is once you build up that book of a multi-asset portfolio of customers, your revenue streams can completely change. You don't get the volatility in that P&L, and obviously this year has been a good example of where a number of FX brokers have really struggled because that volatility hasn't been there. Whereas those brokers with big books of AUM, earning custody costs, earning that consistent portfolio turnover when it comes to shares and single stocks, have not seen that decline in revenues. But it does take a long time to build, and we're working with a number of partners, and what we're seeing is those that are sort of thinking they can dip their toe in the water because it is so easy and so cheap, as we know, and has been in the past, to set up a single stream FX broker. They aren't quite really ready to make that investment into multi-asset, whereas those who've done their numbers, understand the business model is very different, and are prepared to invest in it, have been very successful. So it's not an easy switch that we'll just go and get a white label and move into multi-asset. It really needs to be a proper long-term commitment.
Okay. So we talked about the different interests and kind of point of views of the institutional and the retail companies. But I think that one thing, or at least one of the things that you all share is the issue of hiring people and maintaining employees. And one of the things that we saw in the recent research that we conducted, and also a chatter that I hear in the industry, even here on this floor, is that salaries are going up, and it's becoming harder and harder to hire people and to find talents, whether it is in the technology field or sales or trading or basically any other aspect of the day-to-day of brokers and other firms. So I wanted to ask if indeed this notion is viable and where all this is going. So Richard, maybe you can.
I haven't got much to say on that, to be honest, in as much that it's, I don't know, really don't. It's arguably, yes, I suppose. One area that springs to mind maybe with regards to, we're all technology driven, the prediction I would have said this year regarding multi-asset and we will enhance our multi-asset class capability, and that will come with the enhancement of technology as well. As a consequence, that requires devs. Devs, yeah, I think they're a pretty expensive commodity, certainly getting good ones. So that's a stream that we see coming into the offices, and that comes with the responsibility of paying these guys well. In terms of FX itself, no, I haven't got much to comment on salaries in the more FX-driven world.
Anyone?
Yeah, I can comment on that a little bit. I think it depends on the discipline or the skill set inside of. I haven't noticed like a huge problem. We've always had a challenge recruiting quality IT, like app dev guys, just quants, because you're competing with the world and all these different industries, and those people tend to not like to work on the same thing longer than a few years, and then their brains are off on something else, right? But that's always been a challenge. I think you saw maybe some senior management and executive departures across the industry. I don't necessarily associate. I think they said, well, the industry's changing, regulatory and all that. I attributed that more to just burnout. A lot of those people that I saw leave were 20 years in the space. They just want to do something different. We haven't experienced a major issue. Prices have gone up in compliance, legal, for sure, but not 100% more or 50% more or anything like that. Our biggest challenge is, and I think probably will continue to be the IT guys in general, app dev, quant, stuff like that.
Okay, so Mo, let me continue with you on a slightly different topic on market data. It's always an issue, and during the last year we saw quite a few changes on that. So what are the main options that brokers are facing, and what are the risks as well?
Yeah, market data has been one of those 800-pound elephant, gorilla, whatever metaphor you want to use, for many, many, many years. And over the last, I would say, probably 3 to 5 years, the exchanges have gotten a lot more aggressive in proactively reaching out to different brokers and talking to them about where they're getting their market data from. And so we've tried to be proactive. Inside the group, we provide market data on everything inside of our symbol universe. The challenge historically has always been from a B2B perspective. If you provide your market data to a broker, and that broker also then wants to redistribute the data to other brokers, the equation kind of fell apart, right? They had to now go direct to the exchanges themselves. So we've been able to solve that and allow customers of our customers to consume data through us effectively, to simplify the whole process. It's very expensive to have to interact with different exchanges. You have to have people focused on that. You have to have people focused on the reporting. It's yet another infrastructure thing that you have to own, but you don't have to own, right? And that's kind of been our thing, is like, don't worry about the market data. We can provide market data. If you take other services from us, we can probably make it very economical for you to do that as well. But it's a risk for brokers. If you're consuming market data and maybe not paying what you should be paying for it or not reporting, it can come back to bite you. I've been involved in a variety of different larger transactions over my career, and one of the hurdles in all of that has always been historical data liability. And it's usually in the millions and millions of dollars, to the point where sometimes it almost stopped bigger transactions because of the historical data liability. So you have to address it. You don't have to own it. I don't think it makes a lot of sense to own it, but you're going to have to tick that box. So it's something that we're talking about. Again, as people struggle with their identity, what they want to own, what they want to build versus buy, to quote Andrew, this is something I don't think makes a lot of sense to own.
Andrew?
Yeah, this comes back to the multi-asset conversation, which I think we've covered quite well, but from our standpoint, just want to make it clear, it is extremely difficult to integrate multi-asset alongside FX or crypto if you were a single stream broker before. From my perspective, in no way is there optionality. Mo took the words out of my mouth. In 10 years from now, there will be absolutely no room in this industry for single stream FX or crypto or single asset only providers. I believe there will be regional demand for broker-dealers servicing speculative retail trading, but you're going to need to offer a holistic solution to clients that includes stocks, FX, crypto, everything. So the market data challenge is actually one where I think the industry and the institutional side of the space has evolved in a very exciting way over the last few years. I agree there's certain areas where it's not the broker's job to necessarily solve the whole problem, but looking at exchanges like SIBO, who have gone from individual per user charges, and a broker with 100,000 clients to offer individual equities was looking at an increase in fixed costs of tens or hundreds of $1,000s a month. There are progressive approaches to market data that we've worked with brokers on, we've worked with our partners on, and I feel the institutional side of the space is really coming around on that. So it is a challenge that's attainable. It is difficult, but it's not optional, I don't think. If you're a broker in this room, in any scale of the industry, in any region in the world, and you're thinking about being single stream for more than the short term, I don't think that has longevity. So if you're not having those conversations and looking to figure out where am I going to engage progressive exchanges who have a retail specific market data license and understand my business, if I need a regional exchange, where am I partnering with a liquidity provider or partner who has economy of scale in addressing market data challenges? And back to data, how am I using my overall relationship with that partner, as Mo said, to facilitate these different expense lines? Am I sending them good enough flow? Am I receiving, we all have FX market data for free, and like I said before, if it's free, then you're the product. And we know our STP flow, our hedge flow out to our liquidity providers is how we pay for our FX market data. In the right solutions, that can also be routing the right flow to your LPs, having intelligent conversations about what type of flow they're looking for, what they're not, can facilitate a conversation around how they can provide assets like market data to you in exchange for better flow, in exchange for less internalization. And all of that conversation comes down to what is my business, what data is it generating, and how am I having an intelligent conversation about that? And again, that's where the plumbing of the industry, aggregation and execution will always be our core focus, but the data side of this and enabling our partners with intelligent analytics and ways to have conversations at various different levels of sophistication, I think is absolutely paramount to all of these different themes.
On this note, we have a few more minutes, so I want to open the floor for questions. Anyone? Come on, it's the CEO's panel. Okay, so if nothing else, let's just make a quick round. And I want to ask you, following on my first question about the current trends, what do you think we'll see in 2020? If I meet you in 2020 at the CEO's panel, how would you summarize this year? And what would you say that changed, happened, and what are your forecasts for it? So, Andrew.
Very quickly, I believe the dust will settle on ASIC. We'll have finality in terms of the major Tier 1 regulatory districts and how they approach leverage, leverage caps, net capital requirements, et cetera. I think we're going to start wondering and looking at which Tier 1 regulatory environment emerges as the location. It's very interesting as we've followed regulatory arbitrage in the Western countries or Tier 1 regulatory environments around the world. They've kind of all copy-pasted each other's requirements, and I think that it will be interesting as these regulations start to settle in to see where the predominant district is. At ASIC? Is it going to come back into the ESMA world? As Brexit settles down, where does the UK look, and what does it look like moving forward? I think we'll be having a lot of those proactive conversations about longevity and solidity and data alongside all of that.
Well?
I mean, there's a few different areas you could talk about. I think the markets, I think we'll see very much similar to what we saw this year in the markets again next year. I think there's still some geopolitical things out there that are yet to be resolved or next year are going to be yet to be resolved, i.e. the U.S. election, things like that. So I think the markets are still going to be challenging for brokers from a vol perspective. So I don't anticipate a big change there. I agree with Andrew. I think that this regulatory arbitrage will go away. I think people will stop talking about can I survive and be viable offshore. I think that's the go-to thing, has been for the last 15 years, whether it was the U.S. or Japan. And now in Europe, I just don't think that's a long-term viable model. So I think that won't be an option. But I agree. I think people will be trying to figure out what's the best place for me to be based to get the most bang for the buck, to reach the most people, and that has the most friendly, regulator. So I see that. I'm hoping that we're still hoping we're going to see something cool come out of crypto. So I haven't given up on that. But I think that's really just about true innovation. I still feel that that is an area of the market that has an opportunity to develop something unique, maybe not with another coin, but with maybe something inside the transaction cycle or process or how we clear things. But I haven't seen it yet. But yeah, not anything major. I don't think. A little bit more consolidation as well. I think as people struggle with their identity, we'll see some people fall out, and we'll see some people merge and things like that.
Arpal?
So I agree with a lot of what people are saying. I think we're entering into a phase where some of the uncertainty is now passing, so people will focus back on their businesses. I think people are going to look for how to grow. They'll probably do more partnerships. I think costs will come down, as I've said, and I think volumes will go up because of that. And I think people will... we'll mention one thing. So we actually do quite a lot of work on the crypto side. We run a separate exchange called Mint Exchange on the crypto side. And there is a lot of very interesting cross-pollination of ideas from crypto to FX and vice versa. So market structure things from FX that are coming into crypto have helped a lot. But there's some very interesting things in custody and settlement on the crypto side that may very well be introduced into FX. Again, I think we're now, a lot of the volatility of regulation, volatility of uncertainty around how things would be treated, even on the crypto side, have sort of settled. And so people are now operating on just the regular blocking and tackling of their businesses. And I think that's actually going to lead to some good things about people working well together and and a lot more coordination?
I think we will continue to see small players getting squeezed out of the market, those with low capital bases. Their business models have been heavily challenged by the leverage caps, so I think they will continue to see that into next year. I think we will see more M&A now. I think a lot of M&A was put on hold while people understood how companies would deal with the new intervention measures, and I think there's been enough run rate for companies looking to buy companies to understand that this is the new norm and understand that this is now the new profitability. So I think a lot of that was put on hold. I think we should see more of that next year. And then I think as brokers now strive to improve efficiency, we will see lots more outsourcing, using third-party vendors, whether it's for data or for delivering price feeds or whatever it is. And I think people have become less precious about owning their entire ecosystem. And I think people will now outsource bits that they don't understand or don't have the capital to invest in. So I think those are the three trends we'll see next year.
Thank you. Richard?
I think volatility is not going to get much more exciting in the short term. I would like to see a resolution on Brexit. I think that will give some stability to society as a whole. The downturn that we've been living in, sitting on our hands for the last 3.5 years. But I think there's probably, from an economic perspective, it's going to be quiet, and I think that will not help necessarily with volatility. There may be some hope. I think we hear some noises from, and I'm not normally one that promotes China hugely because of the uncertainty, but I think there may be some growth in that area and some greater openness, which I'm sure will encourage a lot of people to relook at that. I think there'll be, I agree massively with what Andrew said there in terms of not being precious, not building your own stuff. I think there'll be a growth, certainly from our perspective in technology, looking at faster and better and more intelligent and more efficient ways to do things. And I definitely, well, the crypto part I kind of find interesting. I'm not a great believer in the coin as well, but I think that from a technological perspective, I see that. And why it hasn't happened already, I kind of question the idea of settlements and utilizing the backroom technology, as opposed to stop talking about the coin itself. There's a lot more interesting things that are going on behind that coin.
Thank you, everyone, for this amazing conversation. You're more than invited to continue this talk with the panelists afterwards. I'm sure that they will be more than happy to meet you all if you have any other questions that you were too shy to raise here. Thank you all and enjoy the rest of the agenda.